What if you have an emergency and there are no savings in the bank? Among many options, borrowing from your life insurance policy is probably the best option. Your cash value whole, universal, or variable universal life insurance can bail you out, especially if you've been paying for years. Remember that the quick cash loan option is a future of your policy. Wasn't it one of the reasons why you bought it in the first place? Before you borrow from your policy, remember that there are several pitfalls against taking a loan. First, there's the danger that you might forget to pay the loan interest and subsequently affect the death benefit adversely. Second, you might believe that dividends from your variable universal life insurance policy will be enough to settle the loan. However, the biggest item that borrowers and even insurance agents fail to understand is the tax aspect of such loans. It is a complicated method that revolves inside a life insurance policy. It's like you build a house on top of a hidden sinkhole. You are not aware that the sinkhole may swallow your house at any moment. You'll probably be surprised to know that there could be better options. One is by opening a home equity line of credit, HELOC, or sometimes taking out a personal loan might be more to your advantage. You've probably decided to buy a type of life insurance partly because of its cash value feature. You've probably thought it was a good idea to have a ready source of quick cash in case you need it. If you are planning to borrow from your policy, pause and think carefully. Does it really make sense to do it now under your circumstances? A whole life insurance will cost you more in premiums, but it won't expire. The insurance coverage remains in effect as long as the insured is alive. The premiums may be higher, but there's benefit in it for you. The company invests the money you pay into the policy after they get what they need for the death benefits. This investment becomes the cash value of your policy after a few years. In effect, the entire life insurance policy will have two values. First, there's the face value, which is essentially the death benefit. Second, there's the cash value that technically acts as your savings account. When the investment increases the amount of death benefit, you can then borrow from the tax-free cash value. When you take out a loan, you are not taking money out of your death benefit. You are borrowing from the insurance company and using your policy as collateral for the loan. Another benefit is that the loan does not affect your credit score and does not need an elaborate approval process. It does not even need a credit check before the company approves it. This is easier than getting a bank loan or a credit card because you are merely borrowing your own money. When you borrow against your policy, you don't have to explain what it is for. It means you can use it for anything. Pay your bills, buy a sports car, or travel to the Himalayas. Furthermore, the IRS will not treat the loan proceeds as income, so it is tax-free. Like any other loan, you have to pay it back with a corresponding interest. The bonus is that the interest rate is much lower than for a bank loan or a credit card. The company will not require a regular monthly payment. This may be good or bad for you depending on your preference. Of course, you need to pay back the loan in a timely manner. Even with a low interest and flexible payment schemes, make sure you pay it back. If you don't make regular out-of-pocket payments, they will add the interest to the balance. Interest continues to accrue whether you pay the bill monthly or not. If you let it accrue, you will risk letting the accrued interest exceed the policy's cash value. This may cause your policy to lapse. Insurance companies want the policies to remain active. They give the borrowers many opportunities to keep the loans current and avoid lapsing. In case you let the policy lapse, you will have to pay taxes on the cash value. If the borrower does not pay back the loan before the insured person's death, it will affect the death benefits. The insurance company will deduct the outstanding loan principal and all accrued interest before they release the proceeds. Before you actually borrow, it would be good to ask your agent to do an in-force illustration. This simulation will show you exactly how your loan will affect your policy. Also, check out your other options and weigh the advantages and disadvantages of borrowing against your policy. That's it for now. On our website, you can find more posts and podcasts as well as calculators and other financial tools. Are you considering borrowing against your life insurance policy? We would love to know your thoughts, so feel free to share them on the comments below. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube.